Hi students, in this video we are going to see about accounting terms. I am Mahalakshmi, working as Assistant Professor of Commerce Computer Application in V.V. Perumal College for Women, Virudunagar. So, before going to do the accounting, this journal, ledger, trial balance, final accounts, we are going to see the basic accounting terms. So these are all the accounting terms we used in while preparing accounting. That is assets, liabilities, capital, transaction, goods, fixed assets, current assets, account, cash and credit, debtor and creditor, debit and credit, ledger and journal. We are going to see this one by one elaborately. So first we are going to see what is assets. Assets are properties of every description belonging to a trader. So the cash, stock, building, machinery, furniture. In case of assets, first we have a cash. So cash in hand. So which part of cash that can be kept in hand of the owner is also called as the assets of a business. Then building. If a business purchase a building for their business purpose, that building is also come under assets category, like that machinery and furniture. So assets are properties of every description belonging to a trader. The next one is liabilities. So liabilities are debts owing to others by the trader. So if the business or the sole proprietor bought a loan from the bank, that loan is called liabilities of a firm. Okay, so assets are in term Tamil சொத்துக்கள். So liabilities called in Tamil பொறுப்புகள். Okay, so next one, capital. So it is the amount with which a trader start the business. So if a person having a rupees 10 lakh in their hand, if they want to start a business, they can invest the amount of rupees 5 lakh as a initial investment. That amount is called as capital. So capital is the liability of business to its proprietors. For example, in 1/1/2020, Mr. A started a business with a capital of rupees 5 lakh. After 1 year, that is 31/12/2020, Mr. A had a amount of rupees 6 lakh in their accounting. So the difference between the 5 lakh and 6 lakh is rupees 1 lakh. So 1 lakh is a profit. Okay, so capital is equal to assets minus liabilities. So balance sheet left side we have to mention all the assets, all the capital and the liabilities. On the balance sheet right side we have to mention all the assets. And the next one, transactions. So it is a transfer of money or money's worth from one account to another account. So if the money is transferred from one account to another account is called transaction. When the trader purchased the building for rupees 2000 for cash. So since the building increased and cash decreased. So here if the businessman purchased one building means building is receiving benefit and the cash the giving benefit. Okay, so for purchasing the building they can pay cash. So building value is increased, cash value will be decreased. The next one, goods. So commodities bought for the purpose of resale are termed as goods. So if the businessman purchased raw material for manufacturing the goods, that raw material is called as goods. Okay, so Mr. A buying cloth for resale purposes can be treated as purchase of goods. Then fixed assets. Asset mean to remain in business for use and not for resale. So that asset that can be acquired by the business, which is used for a long period, not for resale. That asset is called fixed assets. Usually the assets are classified into current assets and fixed assets. Fixed asset may give a benefit to the firm for more than 1 year. That is long period of time. It is called fixed assets. For example, a cloth shop owner purchases building, computer, showcases or the fixed assets of the businessman. Then current asset. Current asset meant for conversion into cash is called current assets. So it can be easily converted into cash, which benefit is also have used in the business for a period less than 1 year. Okay, the cloth shop owner buys cloth for resale. Okay, so here we can represent the goods. Goods after reselling we have a stock. So stock of cloth is the current asset of the businessman. Then account. So what is account? Here we can mention A by C is a short form of account. A clear record of transaction affecting a person, an asset or profit or loss is known as an account. Next, for cash or on credit. So here we is the basic accounting term. So these are all the accounting term which can be used in the used while preparing the journal, ledger, trial balance, and then final account. So these are all the basic important term you must know before preparing the account. Okay. So for cash and for credit, you are well know what is cash, what is credit. If we are purchasing the goods for cash, that is called cash purchase. If we are purchasing the good on credit basis, that is called credit. So current assets and fixed assets can be bought for cash or on credit. In case of cash transaction, payment is made on delivery. So at the time of cash transaction, we can pay the payment while we can make a delivery. Then purchase or sale of goods on credit means to receive the goods or part with it or without any payment of cash at the time. So we can purchase the goods, later on we can made payment, that is called credit purchases. Then debtor and creditor. So debtor is a person who owes money to the business, sold good to B for rupees 1500 on credit. So here B is a debtor. So the business firm sell goods to their customer in credit is called the person who receive or who purchase goods from the business firm is called a debtor. Here and then creditor is a person to whom the business owes money. So here the business receive or purchase goods from other person on credit. So that is called a credit purchase. So here C is a creditor. Here C give money or supply goods to the business firm without receive any money. So C is a creditor. Then debit and credit. A transaction affects two accounts in the opposite direction. In basic rule, we have every debit, we have also have a corresponding credit. For example, if we purchase goods from B for cash, so we have what can be done here. So purchase of goods. So here we are going to purchase goods from B for cash. So here we can make a journal entry, purchase account debtor to cash account. So every debit we have a corresponding credit. Here we can purchase goods, that is a receiving item. Then we have to pay cash as well as a giving item. Okay. So every credit we have a corresponding debit. So amount which receives the benefit is debited and the account which gives the benefit is credited. So purchase the receive benefit and then cash is the giving benefit. Then to debit an account. So debit an account means to record the transaction on the left hand side. So on a ledger account we have to debit all the transactions. So that is called debit side account. Then to credit an account means we have to record the transaction on the right hand side of the ledger account. So that is the credit side of the account. Next, journal. Journal is the book of first entry. Business transactions are first entered in the journal before they are taken to an appropriate accounts in the ledger. So before going to prepare a ledger, first we have to prepare a journal entry. Next, ledger. So ledger is the main book of account. It contains all the accounts of the business in a well arranged form. So here we have to open each and every account separately. If a business start with a capital, here we have to prepare a capital account. Then proprietor account also we have to maintain. Then if in case there is any purchase, we have to prepare a purchase account. If the purchase is made on cash, we have to maintain a cash account. Okay, sales account, cash account, capital account, buildings account, furniture account, debtor account, creditor account, all the separate account that had been maintained in the ledger account. Okay, hope you are all enjoy the basic accounting terms through this video, and I hope all you are know or having some idea about what is accounting terms. Thank you so much.